We are diving deep into the markets today, and there's been a measurable resurgence in one particular area.
The SPAC arena.
Exactly. We've got two significant new players hitting the market. Bleichroeder Acquisition Corp, trading as BBCQU, and Soren Acquisition Corp, which is SRU.
And these listings, they really mark a fresh start for SPAC issuance here in 2026.
So this is more than just ticker news. For this deep dive, we really want to get under the hood of these blank check vehicles.
Right. For you, the listener, we need to break down the structure, the incentives for the management teams, which can get complicated, and, of course, the big risks that shareholders take on.
Especially when they're targeting huge sectors like healthcare and technology.
Exactly.
Okay, so let's start with the brass tacks, the results. What did this dual IPO event actually look like?
Well, Bleichroeder, BBCQU is the bigger one. They raised a pretty hefty $250 million.
So that's 25 million units at the standard $10 each.
At $10 a pop, yep. Their units started trading January 8th, and the shares and warrants will split off later on.
And their focus seems broad.
Very broad. They're talking North American and European businesses, disruptive growth, tech transformation. It signals they're hunting for a really big, maybe complex, cross-border tech deal.
Okay, and then we have Soren Acquisition Corp, SORNU. They listed a day earlier, January 7th.
A little smaller. A $220 million IPO, which is 22 million units, same $10 price point.
But their focus seems much, much tighter.
Oh, absolutely. SORNU is laser focused on healthcare, and they're not looking for some early stage moonshot. They want established, scaled businesses that they think they can improve operationally.
So maybe a roll-up strategy, that kind of thing.
That's what it suggests, yeah. Finding value in fragmented markets. It's a very different playbook from Bleichroeder.
Structurally, though, they look pretty similar. Both are offering the standard unit.
Right. It's the formula investors demand now.
Yeah.
One Class A share plus 1/3 of a redeemable warrant.
Let's pause on that warrant piece for a second. That fraction 1/3 of a warrant, what does that tell you?
It tells you two things, really. One, the market is healthy enough that they don't have to give away a full warrant to get the deal done. But two, you still need that sweetener.
The sweetener being the potential upside.
Exactly. It's the leverage. It's what keeps the big hedge funds interested, since the $10 share price is basically protected by the trust.
So speaking of the market, the timing here is pretty significant.
It is. These are the third and fourth SPAC IPOs of 2026. Together, they've raised $820 million.
Which is what, like 80% of all IPO activity in the first week of the year?
A whopping 80%. It's a huge concentration of capital. And if you compare that to previous years, 2025 saw only 144 SPACs.
And that's nothing compared to the absolute peak in 2021.
Right. The dizzying peak of 613. The market isn't dead. It's evolved. The money is pickier now.
Which brings us to the management teams. Bleichroeder brought in some very heavy hitters.
Oh, for sure. You have CEO Andrew Gunlack from Bleichroeder LP, and then co-founder Michelle Combs, who's the CEO of SoftBank Group International.
That's some serious executive access. Should mean great deal flow.
Theoretically, yes, but, and this is a big but for any investor, the prospectus flags potential conflicts.
Because they're involved in other SPACs, right? They mentioned BACQ.
Exactly. So you have to ask yourself, if they're juggling all these huge roles, where is their focus? Where's their time really going?
A very fair question. Now, you contrast that with Soren's leadership, which feels much more specialized.
Completely different approach. Their CEO, Arg Ivanarez, co-founded Theoria Medical. Their CFO, Jamie Weber, is from UNC Cap Investment Management.
So you have clinical and financial experience baked right into the leadership team.
And that is their strategy. They're built to tackle targets with complex regulations or to execute those roll-ups we talked about. They're using deep vertical knowledge as their edge.
Right. And before any of that happens, they have to get through the compliance gauntlet.
Which is no small thing these days. We know from the filings that Soren was audited by Withum Smith plus Brown.
And they even named the engagement partner, Zachary Joe Newcomer.
And that might sound like a boring detail, but it's important. It shows how rigorous the process is now. These are shell companies, but they have to spend real money on top-tier auditors and lawyers long before they raise a dime.
That audit cost is the first thing that gets paid out of their operating budget.
It is. It weeds out the lower quality sponsors right from the start.
Okay, so speaking of what gets paid out, this is where we have to talk about the core risk. The sponsor promotes.
The misalignment of incentives. Let's really break down the dilution, especially with BBCQU. It's pretty stark.
So for you, the public investor, you're buying a unit at $10. But the filings show your effective share value immediately drops.
Immediately. It drops to $7.25.
That's a huge haircut on day one. So where does that $2.75 go?
It goes directly to the sponsor. It's a massive transfer of value. The sponsor, Bleichroeder Sponsor 2 LLC, bought almost 9.6 million founder shares for a grand total of $25,000.
$25,000.
Yes. So let's put that in perspective for you. Their average cost per share is about $0.003.
So a fraction of a penny.
A fraction of a penny for a share the public is paying $10 for. They essentially get 20% of the company for, the price of a decent dinner.
And that cost difference, that's the real danger here, isn't it?
It is. It creates this almost desperate incentive for the sponsor. Their goal isn't necessarily to find a great deal. It's to find any deal within that 24-month window.
Because if they liquidate, they lose their 25 grand.
Yeah.
If they close even a mediocre deal, that could turn into $50 million.
The math is just, It's overwhelmingly in their favor to do a deal, any deal.
Okay, but there is a key protection in place.
A crucial one. The $250 million in IPO proceeds, 100% of it, goes straight into a trust account.
Invested in safe stuff like U.S. Treasuries.
Right, so that guarantees the $10 redemption floor. But you also have to watch the cash that's not in the trust.
The unrestricted operating budget.
Yep. About $1.95 million for legal, admin fees, and so on. And buried in the details, you see that an affiliate of the COO gets paid $25,000 a month.
Every month until a deal closes or they liquidate.
So even if they fail completely, that affiliate still walks away with $600,000 over 2 years. It's another way the sponsor network gets paid first.
The primary protection for the public, then, remains the redemption right.
It is. You, the investor, can always ask for your $10 back if you don't like the deal they propose. That's what holds up the floor price.
But there are other headwinds now. New SEC rules, for one.
Right. More costs, more complexity. But there's also a tax risk that many retail investors might not see coming.
And that's tied to where they're incorporated. Both are in the Cayman Islands.
Exactly. And this brings up the term PFIC.
PFIC. Okay, in plain English, what is a passive foreign investment company and why should an investor care?
It means a potential tax nightmare. If the SEC decides that these SPACs are basically just investment vehicles, which, they are before a deal, they can get hit with this PFIC designation.
And that means?
It means complex tax filings for U.S. shareholders, and more importantly, it can trigger really punitive tax rates on your gains. It can just wipe out your upside. It's a real non-trivial risk.
Okay, so we've covered the structure, the teams, the massive dilution. Let's shift gears. It's time for our "This is not financial advice" segment.
My favorite part.
Given all this baked-in risk, how might a sophisticated player, say a hedge fund, try to play this?
All right, so let's pitch an outrageous but plausible trade. We'll focus on BBCQU because of its tech focus and the huge dilution.
Okay, so the setup is the unit is at $10, but the effective value is $7.25. That's a big gap.
A huge gap. And that gap is basically the price of the warrants optionality. So here's the trade idea. A simultaneous long-short arbitrage play.
Okay, break that down.
The first leg is simple. You buy the units, or just the shares, as close to that $10 redemption floor as you can. You're treating it like a short-term bond with a guaranteed principal.
That's your long leg. Your downside is protected. So what's the short?
The short is how you hedge the sector risk and maybe juice your returns. You simultaneously short a high-flying post-SPAC tech company.
So one that's already gone through the process.
Exactly. Ideally, one whose management or deal network overlaps with Bleichroeder's, or just a really high beta name in the sector they're likely targeting.
That's a clever structure. So if Bleichroeder fails and liquidates,
you get your $10 back from the trust, your downside is capped.
And if they find a great deal, the warrant gives you that leveraged upside.
Right. But if the whole tech SPAC world sours while you're waiting, your short position makes money, which helps offset any potential opportunity cost. You're basically financing your downside protection.
So when we pull back and look at the big picture here, what does this dual launch really tell us? We have BBCQU with its broad tech aim and Soren with its narrow healthcare focus.
It tells us that serious institutional money is still very much in the game in 2026. They're just being far more selective.
These two launches are really the first major test of the market's appetite this year.
Absolutely. And the true test of success won't be the money they raised. The real test is whether they can find genuinely transformative companies within that tight 24-month window. Can they actually justify that extreme dilution the public takes on from day one?
And that leaves a final question for you to mull over. As this market gets more specialized, is a team's expertise like Soren's deep healthcare knowledge enough to overcome the powerful structural disincentive of the sponsor promote? Something to think about as you watch these tickers trade.